Your market news now. Asian stocks stalled at one-month lows, while the dollar held broadly firm after the weak Chinese data and latest policy easing measures. A broad array of Chinese data highlighted intensifying pressure on the economy from multiple fronts, prompting Beijing to cut key policy rates to shore up activity. Meanwhile, U.S. stock futures are lower as Wall Street struggled to maintain its momentum from the previous session. Shares of JP Chase, Citigroup, Wells Fargo and Bank of America were lower in the pre-market, and the moves come after Fitch warned it may have to downgrade dozens of banks, including JP Chase. To give us more perspective, we are joined by Martin Smith, who's a portfolio manager at Anchor Capital. Martin, thank you so much for your time. So you take a look at market sentiment right now. What would you say is spooking investors?
So I think if we look at the US market, it's holding up relatively well. Yes, there are a couple of things, like you mentioned now, around downgrades and the like. You've also seen some data out of Home Depot on the last night that talks to the consumer, and maybe it's a little bit under pressure. So a little bit uneasy there. Also, valuations kind of at an index level are quite elevated at the moment. So US uneasy, but holding up a little bit. But what you've seen really is a sell-off across emerging markets. There's a real risk of sentiment that's affecting emerging markets quite a bit at the moment. You just need to look at Iran for an example, which is now at about 19.20 to the dollar after being 17.50 odd, 17.40 odd just a couple of weeks ago.
To what extent is I suppose the events coming out of China having to do with this risk of sentiment that we're seeing? What role is that playing?
Definitely playing a role insofar as how it leads into emerging markets. Also, we are, as a South African market, also very heavily linked to China, both on the tech side and on the commodity side. So that's affecting us as well as the general kind of risk off that you've seen. So absolutely good point from your side is you've got all these other things in the background, as well as the kind of positivity around China starting to wane a little bit.
Let's stay stateside for a bit, because over the past few weeks, I've had a lot of analysts come on the show, comment on this AI frenzy that we're seeing and talking about tech shares. And that got me wondering whether there are any sectors of the US economy or US equity market that are worth piling into that may be cheaper than the top 7 big tech shares.
So, I mean, we had a presentation the other day. It was called the S&P 490, because you've just seen, like we mentioned, 7 there. It's about, call it 7 to 12 stocks that have just absolutely shot the lights out this year. And those are all predominantly big tech shares. So if you take them out of the equation, the rest of the market's actually looking relatively cheap. Obviously, with their inclusion, the market looks quite elevated, like I mentioned earlier, from a multiple perspective. So if you look at anything under those big tech stocks, you see markets actually looking pretty reasonable / kind of cheap at the moment. If we had to drill down a bit further, I think healthcare is looking quite attractive, and also the payment side of things. I'm talking to Visa and MasterCard, I think, are looking quite attractive.
On another occasion, I would love to have a conversation with you about valuation and how reasonable and open-minded one needs to be to find call it a level of valuation that is reasonable. But we'll leave that conversation for another day. Let's bring things locally. We had ABSA and Nedbank reporting their earnings. What does it say about how bad it is out there? And do you believe some of these, credit loss ratios that we're seeing, especially on the home loan side, whether that's a precursor to what we might see in the property market?
Yeah, so I mean, look, the market's very well aware of these high interest rates and the pressure that you've spoken about that it's going to put on consumers and on businesses. So if you look at that, you see that, yes, while those pressures came through in these numbers, it was largely in line with market expectations. So I think it remains to be seen how it plays out, especially if you look at the fact that interest rates normally take about 6 months. There's about a 6-month lag before the effect really comes into play. So it's going to be interesting to see if we have some nice economic kind of tailwinds that'll kind of support the markets or support the economy. But definitely one to keep an eye out. When it comes to property, I think it's not just the higher interest rates that are affecting things like the bank. I think you've also got structural changes in property, things like vacancies, the way people shop has changed, the way people work and work from home and work remotely has changed. So I think the property one is a bit more nuanced. I think they are facing, like I said, a lot more structural headwinds than just high interest rates in South Africa. But not all property stocks are made the same. Some have offshore exposure. So I think you should be very, very selective when you get into property stocks in South Africa.
Let's stay with interest rates. What's the biggest risk for the Fed right now?
I think the biggest risk is that you see some type of shock outside, because it seems like what they've done at the moment, or over the last 18 months, has started to work. Inflation has begun to roll over. It's looking like job is done there insofar as rising interest rates. I think the Fed will no longer push any interest rates for the rest of the year. So I think they've done what they needed to do, but it just depends on other shocks. If you look at things like maybe oil might creep up, but that'll have kind of secondary effects as well, or things like food. So I think for now they are hoping that things kind of stay as they are, because again, it's looking like job done for them.
All right, Martin, thank you so much for your time. That is, of course, Martin Smith, who's a portfolio manager at Anchor Capital, giving us his perspective on the latest when it comes to the markets. We're going to take a quick break. When we come back, we'll have more news for you.